There we go. Welcome everyone, and welcome Jake Gallagher with BASO, who's going to talk to us today about all things fundraising, secondaries, and I haven't seen the presentation, so I don't know all of what's going to go in there. And then we're really looking forward to the Q&A from this group. So Jake, take it away.
Awesome. Yeah, really appreciate Spencer, and just want to say thanks again to Taylor, Spencer, and Hannah for putting this together. Really great opportunity, and hopefully able to shed some light on kind of how we look at ways to kind of differentiate and identify the right investors, and a couple different ways to approach them. Everyone's a little bit different, but happy to present my screen in just a quick second. Let's see. There we go. All right, can everyone see my screen? Perfect. So yeah, in terms of the goal of this presentation is really just to kind of outline some of the key things that we look at when identifying the right investor for your startup, and that kind of depends on a number of different factors. And then when you're going out and kind of looking at the venture capital firm or the angel investor, what's ways that you can approach them the right way, right? And that could be from intros to making sure that you're writing the personalized message if you're reaching out cold if you didn't get a warm intro. And yeah, so I'll kind of just jump right into it. Let's see. In terms of, before we do get started, I do hold licenses with a broker dealer. None of what I'm about to go over is financial advice. It's not legal advice, and you should certainly consult any personal advisor, attorney, or accountant before you decide what's right for your particular situation. And then, without further ado, happy to give a little bit of background on myself. So I'm founder and managing director at BASO. We operate a secondary marketplace for venture-backed companies, generally starting at kind of the Series B and Series C. We'll work all the way up until kind of the latest stages of pre-IPOs, whether that's kind of Series H, I, J, K, and beyond. Every year it seems to be getting a little bit longer. Private companies in general are staying private longer. It's some 50% longer than it was 10 years ago. And so our firm essentially provides an alternative liquidity solution to your standard traditional exit path of an IPO or an acquisition. We'll essentially work with existing shareholders, whether that's an early stage venture investor, the founder, the angel investors, you name it, and we'll essentially help them liquidate a portion all of their holdings in the company and swap them out with another institution or family office or whatever it may be, as an alternative liquidity source to waiting for that final big exit at the end. Prior to starting BASO, I was principal at another fintech startup here in Salt Lake called North Capital. North Capital was certainly a pioneer kind of in the online private markets. They were backed by Consensus and Franklin Templeton. We worked with a number of the leading kind of online platforms that were out there, from the Angels List of the world, Realty Moguls. We worked with not just online platforms, but also private fund managers across venture, private equity, real estate, hedge funds, you name it. And from there, we helped migrate a lot of our clients from the primary capital raising side to the secondary trading side, and I was pretty influential in kind of setting up that secondaries desk with my team. And we were processing thousands of transactions by the end of it for a lot of our Reg A and Reg CF clients, but also larger institutional block trades, which kind of spurred the movement to kind of go out and branch out to start BASO. And then I've highlighted it a little bit, but BASO is, kind of, we work with current and former employees, that's founders, executives, a lot of angel investors, other early stage investors ranging from family offices, to pre-seed investors, seed investors, Series A, all the way up until, Series B, D, and C and beyond. And then, so a part of our key business is really, when we're working on a secondary transaction is, looking at the company, looking at the stage of the company, the various parameters surrounding that company, and then trying to isolate the right investor, whether that's maybe an existing cap table member, whether that's an outside investor that invests in that sector or stage. And so a lot of the same parallels that a founder might be looking at in terms of pursuing, an initial pre-seed or seed round investment, a lot of that same logic applies to the secondaries market in our core business. Is really just how to identify the right investor for the right company and the opportunity at hand. So I'll just jump into some of the top things that we look at, and what founders that we speak with on a day-to-day basis also look at. It was actually kind of perfect timing that Taylor and Hannah reached out regarding this opportunity to present. We had just internally, we've developed relationships with hundreds of VCs over the past couple of years. And we actually had we hosted like a series, like 50 to 75 different interviews, just to kind of figure out some of the pain points that a lot of early stage VCs were seeing in terms of sourcing deal flow. And then once we kind of concluded that series of interviews, Hannah and Taylor reached out. It was honestly like perfect timing. So this is all pretty relevant data that we've gotten over the past month or two. That's straight from investors that we work with on a day-to-day basis. Mainly they're a lot of times they're on the sell side, but in this case you'd be approaching them as a potential investor. So in terms of when we look at early stage VCs, a lot of them may have a specific thesis that they like to cover. You will see a lot of times it's looking at kind of the ESG angles, or some firms will invest in minority founders, or they may invest in the future of work and community as a new thesis that we're seeing a lot of here lately. And so paying attention to the thesis of the investors is important in highlighting and isolating the one that makes sense for you. Because if you're say at an e-commerce and there's no overlap, there's no effect on in terms of an ESG angle or climate focus, it's just you're selling whatever product it is via an e-commerce solution, it may not be a great fit for an ESG investor. And so reaching out to them with any sort of canned message or anything along those lines may not be received well. It's just not that you don't have a good business or a good model. It's just it doesn't fit their thesis, and so it's not going to work. And the same thing can be applied when you look at sectors or the stage of an investor. A lot of times investors, they don't necessarily put all of these parameters on their websites. A lot of times you have to dig for it. Sometimes you're looking at previous companies they've invested in, or companies maybe they've invested in here in the past 6 to 12 months. Granted, in this environment, there's probably a smaller sample size to look at. But generally you want to see kind of what they've previously invested, when they've invested, because some investors may solely wait for seed and Series A, or they may say, hey, look, we don't want to look at companies below $1 million in revenue. And so you may not necessarily be able to figure out all of those key details until you speak with them, or maybe get some sort of references from people that they've worked with or have invested in the past. And so paying attention to those key parameters. Also investment size, is if you're raising $500,000 round, and an investor has a $200 million fund, and they've got to invest they want to invest a minimum of $1 to $2 million. It may not be a fit just from a pure size perspective. There's some level of discretion amongst all investors and their funds, but some things are just too great to kind of bridge the gap on. And these are pretty all high level kind of things that you can kind of try to check the box on to see if you're going to fit the immediate kind of broad fits when you're looking at kind of geography, whether if you have a lead or if you don't have a lead investor. If you're approaching an investor that never leads and you need a lead investor, then they might be good after you find a lead investor, but they're probably not going to be the person that you want to speak with right away, just because they may not have the incentive to do the deep dive or the due diligence until you've got a lead in place. And same thing with business model or minimum traction requirements. Anything that you're able to kind of pull from the investors' websites or previous investments or through conversations with people that you may have mutual contacts with. The more information, the better when you're trying to build a relationship with these investors. At the end of the day, these investors are individuals and they're human beings, and they don't necessarily want to be always looked at as just a money source. And you're trying to build a long-term relationship with an early stage investor. Just from our work, right? It's like we're typically not working with an investor that invested last year. We're typically working with an investor that's been invested for 5, 6, 7, 8+ years. And so trying to isolate and show that you've done your homework on the investor is key in that approach. And we think it adds a lot of value in terms of being remembered, or at least even if it's not the best fit for their thesis or their sector or whatever it may be, showing that you've done the homework on them is going to make it more likely that they turn around and maybe refer you to an investment partner or an ex-colleague that works at this fund that may be a good fit for you. So just showing that you've done the homework goes a long way. I know personally, I'm as I mentioned before, we don't do early stage investments ourselves. We're mainly on the secondary side, but I can't tell you how many times I get messages where it's very clear that they have not even looked at my website before sending the email or the LinkedIn message. And so it's probably even worse for early stage VCs, and that was one of the key points that a lot of VCs noted to us, is that out of all of their inbounds, some 90+% of them are, maybe not, I think it was like 80%, that were just not a fit for their thesis in a general. So it's almost 80% goes straight to the trash just because it just doesn't necessarily fit the thesis. And it was very clear that that founder didn't do any homework prior to reaching out. So making sure that you find the investor that's generally a fit. You don't necessarily have to check every single box perfectly, and you may not have the ability to check every box because you don't have all of the information, but trying to check as many of those boxes as possible goes a long way with investors. And then when we look at the next slide is the general approach, and this kind of doubles back down on that, that messaging and showing that you've done your homework, right? Is back, like the messages that a lot of times that I will get that I can immediately determine that they didn't do any research on my firm because I'm not an early stage investor, or just you can just think about the vendor messages that you probably receive as a founder from there's countless CRM providers or data providers or email scraper providers that you probably get emails from. A lot of those you can tell right away that they don't know anything about your company, and the investor's going to feel a very similar way. And so crafting a personalized message to that investor, showing that you care to build a true relationship versus just you're looking for money. They understand you're looking for money, that's their business, but they also want to know that you're looking to build a long-term relationship. And how you approach investors a lot of times is going to be how you approach customers. And so, they kind of get a flavor of, what that go-to-market, may look like, or how you might perceive, customers, or how you might approach customers. And generally explaining the fit, this could be simply just kind of like tying back to previous portfolio companies that they've invested in. And maybe, they have broad exposure to your sector or vertical, but maybe they don't have direct exposure to your vertical and your business model in particular. And so there's a gap in their portfolio that you could potentially fill. And that just, kind of, once again, just shows that you've done the homework on the investor, you kind of understand, and, you're not necessarily, and just also doing your homework, you're going to be able to determine if you look at, if they're invested in your competitor, then you probably are not going to want to reach out to them. But, the more that you can, personalize that approach, I think it yields far greater results. And then obviously you want to include your talking point, and there may be, this elevator pitch in your outreach that you include in 90% in some variation or another. You obviously want to set some sort of hook with the investor to get their interest and for them to, want to schedule a call and learn more. Investors, like I said before, they're people, they're looking to build long-term relationships, and Just going out of your way to show that you've done the homework to learn a little bit more about them as a person, them as a firm, their strategy, and how you could fit, and how they might be strategically a fit for you, also goes a long way. Let's see. And then, these are some, key talking points, relatively high level on the pitch deck. When you're looking at the problem that you're trying to solve, VCs, the general model of a VC is they're going to make, 20 to 30 investments. A handful of them have got to, it's going to generally be one or two that are going to provide most of the returns for the fund. Some are going to break even, some are going to give a little bit of a return, but most of them are going to fall flat, especially in the early stage market. So they're looking for big problems at the end of the day. And so when you're looking at presenting this problem from in your pitch deck is, can you describe the problem clear and concisely, that way they can understand it immediately, right? The average time, I think most people said they were looking at, pitch decks were ranging from, could be 30 seconds to, maybe 90 seconds. And if they don't understand your problem, or they don't understand truly the gravity of your problem, you might be on the shorter end of that 30 seconds. And so describing that problem in a clear, concise manner definitely goes a long way. And then when you look at, how are you going to solve the problem in your solution? Are you different than the market? How are you different from the market? Are there competitors in the market, that are large incumbents? Is it a relatively new market that you're helping define the category? There's kind of a million different ways to look at it, but, presenting your solution, how you plan to solve the problem, or how you're currently solving it. That's just a key slide deck. And then the competitive analysis, like I said, kind of touched on it with are there other incumbents? Are there substitutes that are in the market that, maybe there's not a great need for your exact solution because it's already partially solved by another. Clearly defining why your company and the timing and the product that you're working on is a winner, and a winner by a large margin is going to be, a big part of talking that investor into wanting to learn more and schedule a call so that they can hear that pitch and presentation from you directly. Looking back at the market analysis and kind of describing that problem is, how large of a market is it? Is it a business that you might be able to grow at max, maybe 10 million in revenue? If so, then it's going to be pretty difficult for a venture capital investor to want to make that large bet, just because the return is unlikely to yield a 15, 30x return in order to justify the returns of the fund. So you be able to reasonably calculate, things like your total addressable market, maybe even maybe you have a specific TAM to start with, but then as you continue to grow, what's maybe the larger market that your initial TAM is a subset of. So, reasonably be able to quantify these problems in these numbers. If you go out and say it's a $100 trillion market, that's also maybe a red flag as well with investors is, while they want a big problem in a big market, they also want you to kind of hone it in within a reasonable level, and be able to clearly define how you got to that, relative TAM or market size. And then also showing kind of traction and revenue. There's a lot of different opinions when it comes to, how much you should divulge in your pitch deck. Some investors will say, or some, advisors or whatever it may say, maybe just stick to historical revenue. If you're pre-revenue, then just show maybe the amount of traction, or if you have an MVP and you've got some initial user interviews. Depending on your stage, it may vary slightly, but my personal opinion is the more is better in terms of showing traction and revenue. It just better clearly shows that you've got a solution to an existing problem, and it also confirms that there actually is a problem. There's a lot of times where people build a solution and then they'll go out and look for a problem to solve, versus kind of finding a problem and then building the solution to really solve it. And then, obviously the team and why you, right? And that's a big thing. And I've kind of touched on it a number of times here is, it's a long-term relationship, and a lot of times in the earliest stages of a company, an investor is really betting on you, the founder. And so, what was your previous experience that, kind of set you up to, solve this problem and be the person to execute? And maybe it's you and your co-founders or the early stage team that you've built thus far, depending on where you're at. But really breaking down the team and why you're the best team to solve this big problem is going to be key. And then ultimately putting some sort of ask in the deck of, maybe it's high level of how much you're looking for, what's the pre-money or post-money valuation, to kind of, also kind of tie back to the traction and revenue, depending on the stage. Obviously, if it's pre-revenue, there's certain, there's various resources that you kind of go out there to, see, relative, what's the average valuations for marketplace pre-seed companies versus seed, SaaS companies, depending on the revenue. A lot of investors in today's market are, focused more and more on multiples and in traction. So, when it comes to, the unit economics, is this a business that's going to be able to be profitable? And when you're looking at this pre and post money valuation and a revenue, if you've been around for 4 years and you've got, $1 million in revenue, maybe it doesn't make sense to ask for a 50 million valuation. And so, certain things like that within reason, a lot of investors will, at least ask for the next call and for a due diligence meeting. But if it's egregious and completely out of the norms, then it might be a quick pass and an easy one. Let's see. And then, I think when it comes down to the actual, the presentation itself, right? So, we've kind of talked about, things to look for when you're trying to identify the right investors. Now that you've identified them, you crafted this personalized message, you've kind of put together your pitch deck, you sent it to them, you've gotten at least the initial hook, and now you're presenting. If you look at, really the key things is how you come off in a pitch. Are you pitching with confidence? Does it sound like you've practiced, right? And when it comes down to, practicing, that could be with your colleagues, that could be with your friends, that could be with your family, could be with your advisors. If you work at a co-working shop like we do, maybe you're, presenting with the group next door. Whatever you can do to just kind of iron out, the pitch and the presentation, and it'll help identify, maybe where points in the presentation aren't that clear, right? A lot of times, venture capital investors, they are generally very smart, but they're not necessarily always an expert in every field, in every sector, or every business model. So, when you're describing the problem, how you're solving it, maybe there's a point that's not as clear. And if you can make that as clear as possible to someone that's not an expert, before you pitch a VC, then it'll be much easier for that VC to understand the problem and the solution. And so, as you kind of practice, you'll want to optimize the pitch. But even as you work through the first initial couple venture capital pitches, is that, you'll want to optimize that pitch from, time to time, depending on the investor as well. When you're looking at, some investors, you may try to curtail this pitch to them in particular. Whether it's, making, references back to previous portfolio investments and how they entered and how they exited the market. There was, the Airbnbs of, or the Ubers of. I don't know if you necessarily want to go that approach, but if you can highlight the, previous portfolio companies that they've invested in, how they've entered the market, and how you plan to do so as well, that would be, certainly advantageous, and try to optimize the pitch. And if you hear the same venture, if you hear the first 3 investors ask the same 4 questions, you maybe look at, changing the way that you present those slides or those bullet points. But also maybe, ask, how can we change the slides to make it maybe more clear and obvious, to avoid those questions. Or maybe you present and you address those questions in the pitch itself. There's a number of ways to kind of optimize the pitch. It's just a matter of trying to figure out, what the problem is, and where it's unclear, why is it unclear, and how you can make it clear. And then obviously know your numbers. It seems so trivial and so obvious, but you'd be surprised at how many investors or how many founders just don't know their numbers, in terms of, what's the client acquisition cost, what's the lifetime value of a client, who is the ideal client. You may think you have the ideal client, and then maybe maybe the data suggests that you should focus elsewhere. And so knowing your numbers, and depending on your business model, there's going to be certain KPIs that you're going to want to pay close attention to. If you're a marketplace model, there's take rate and various other kind of metrics that you'll want to focus on. And if you're a SaaS, you're a SaaS business, you're going to have various other metrics that you're going to want to take a look at, because those are metrics that investors are going to use to compare you against other various comparables or other companies that are perhaps pitching them on the same idea. You just never know if they're speaking with just you or your investor as well, or your competitor as well. And then obviously transparency is just, I think investors, as much as they love the confident founder and the innovator in the space, they also want, they want you to highlight the strengths and kind of where you're knocking the ball out of the park, but also admitting kind of where you've made the mistakes or the lessons that you've learned along the way. And maybe there was a pivot that you made. How did you decide that you needed the pivot, or how did you recognize the timing of, all right, well, we weren't necessarily seeing the traction here, and then we decided to try another strategy or another target market, or maybe a slightly different presentation or a different go-to-market strategy. And that was what worked. And so being able to isolate where you maybe weren't 100% correct and how you utilize that to turn around, make adjustments, and excel and execute from there goes a long way in terms of just showing who you are as a person, your resourcefulness, and then also just awareness in general. And those are some of the main slides. The next one is just kind of a thank you slide, but happy to take a quick pause and start answering any questions.
This is great, Jake. Thanks so much. I saw a couple of comments in here. If others have comments or questions, that would be awesome. One I put in was back on slide 5, you were kind of outlining, in my mind, a table or with columns of like how to track, the conversations. And one of them being, that's not on your slide. Oh, it is on there. Yeah. Lead or follow, which I think is important. Besides, and then to Todd's question, besides looking at their website and besides paying for a subscription to PitchBook, do you have other tips or thoughts on how to go out and get this information?
Yeah, that's a great point. So, a lot of times, there's Crunchbase, which is another, it's not quite as comprehensive as PitchBook, but that's certainly, a solution for you. It may take a little bit more digging, but if you're able to kind of look at their portfolio companies, and if you're able to synthesize any of that data from, a lot of times they'll say when they made the investment in the company. So if you click into their portfolio company, a lot of times they'll show, all right, it was our seed investment, and then they'll outline some of those parameters within their website. There's also, a couple other products that are out there. I think, there's plenty of lists that if you just Google list of venture capital investors, I'm sure you can probably find a number of them. What I've realized is that, a lot of those, kind of lists and resources you have to be careful of, and you kind of want to also do your own homework. Just because even PitchBook and Crunchbase, they're not necessarily always 100% accurate. And it may say that it may say they do consumer-oriented investments, but maybe they did consumer-oriented investments 5 years ago, or 3 years ago, and their latest fund, they won't touch it. So it all depends. There's Crunchbase, PitchBook. I think there's one that I see quite frankly is the founder suite. It's like a CRM. I'm not endorsing any products here by all means, but it is one. They've got some great marketing. They pop up on my LinkedIn all the time. But yeah, there's a number of different resources out there that you probably pull to get information on the investors' general parameters. But you'll want to do your own due diligence in terms of trying to verify that as best possible through resources on their website, or a lot of times the underlying investors at the firm, they'll post a lot on LinkedIn about the types of companies and if they led a seed round. So sometimes it's looking at just digging through LinkedIn posts by the company or by the investors on their team.
Awesome. Yeah, Jeff Erickson also put in Founder Suite in the comments, so there's two for that. You mentioned kind of an order of operations. Can you talk more about like cold outreach, warm leads, or warm introductions? What are in your mind and from what you've seen, best ways to go about approaching and creating that relationship with the investor?
Yeah, I mean that's a great question. So obviously, if you can get a warm introduction to an investor, whether that's a full venture capital firm or an angel investor, if you have a mutual connection that that is willing, the big key is if they're willing to make that introduction, and that goes a long way, right? Is that if they're willing to kind of put their neck out on the line for you through an introduction, then they must believe in the idea and they believe in you, but also believe that they also might believe it's actually a good fit for the firm. So that was one of the things that a lot of venture capital firms looked at from in our discussions is they said a lot of times the intros were actually a better fit. Just back to the thesis part of it is that 90% of those, or 80-90% of the inbound is just not a fit based on easy to eliminate thesis and parameters. But the intros generally kind of fit their thesis and parameters because people that are willing to make that intro or have the relationship to make that intro know the ins and outs of the firm maybe a little bit better. And then if you're doing the cold outreach, I think it goes a long way in terms of trying to build the relationship first. Obviously, if there's ways for you to kind of, if you're planning on going and starting a firm over the next 6 months, maybe you've launched it today, if you can start building those relationships and try to identify these investors maybe a couple months before you actually go for a full fundraise, maybe that allows them to kind of follow your company on LinkedIn, or maybe you don't necessarily reach out to them and say, hey, I'm not necessarily raising today, but would love to include you on a monthly newsletter as we look to raise in the next 3 to 6 months. And that it offers a genuine way to establish that relationship with the investor. And then, if they opt in to get the monthly newsletter, then they're obviously someone interested in tracking the progress. And so you can kind of get a soft indication of whether or not they might be interested or a fit.
Very cool. And I think that answered Todd's question that he had about how early to start relationshiping with VCs. Very cool. Awesome. Thanks, Jake. We usually keep these to about 45 or 50 minutes. I think we're right about on time. On your last slide, does it show how people are going to get in contact with you if they have questions? I know they can find you on LinkedIn.
On the last slide, let's see. Yeah, my contact info, you can just Google me on LinkedIn. And then my email is just jake@myvaso.com. You can always go to the website, myvaso.com, and submit a request, and we'll try to get back to you as soon as possible. And if there are any founders actively raising that are looking for an intro to a VC, like I said, we've got plenty of connections at VCs. We don't formally raise capital for early stage investors, or for founders, but we'll kind of share decks with the appropriate investors from time to time. So if you guys are looking for funding, happy to at least try to get the conversation started and let you run with it from there.
Great. Thanks, Jake.
That's awesome. Thanks, Jake.
Awesome. Thank you. And really appreciate the opportunity once again.